Back on April 2nd, I asked the question, is this the peak in mortgage rates? Oil was surging, war was escalating, and mortgage rates were pushing higher. Fast forward to today, oil just dropped 15%. Mortgage rates are falling, and it looks like we may have just seen the top. So did I call it? Well, that was back on April 2nd. Mortgage rates were at 6.46%. Oil was surging due to the war and, of course, the disruption in the Strait of Hormuz. Inflation fears were very rampant, pushing the 10-year yield that I talk about all the time up, and away. And mortgage rates since then have now come down. We're sitting at around 6.35%. Today we had peaked as high as 6.46%. This isn't just the last few days since the ceasefire was announced in the Iran-United States conflict. Now, that drop in oil was pretty sudden, and bond yields, of course, eased quite a bit after we saw that. So did we nail it? Well, from war to oil dropping, inflation dropping, 10-year dropping, mortgage rates dropping. Well, what changed? So we got to go through this, and then we got to figure out if it's here to stay and what comes next. So let's talk about it. Now, keep in mind that this ceasefire, at least in my opinion, it's temporary, right? It was a 2-week ceasefire that was announced. And you can make the argument it's a bit fragile. At any point, either country can break the ceasefire, and, well, we all know what could happen after that, right? The market's going to react just like it did, and it's not going to be in a good way, meaning oil will just rise again, and we'll see everything go back to where it was. That can happen. It certainly can happen. And I think that oil, even though it came down, I still feel like it's volatile. I feel like it's rebounding towards $100 a barrel after it dropped all the way to $96 a barrel. So it's still kind of, in that range where you're not so sure what's going to happen. Look, rates are where they are right now. I am going to tell you that, we were close to, right around 6% earlier this year. The 30-year fixed, now we're in this 6.3 to 6.4% range. We're not in a straight downtrend. I don't think this means, well, we're in a ceasefire. Oil's going to come back down to where it was. 10 years going to go back, and mortgage rates are just going to drop right back down to 6%. I don't think we're in that situation. I think we're still in this sort of volatile situation, albeit less volatile, okay? But we're getting enough macro shocks here that would make me think that there's still volatility to come. My base case is this. I think we ultimately get a longer ceasefire, perhaps, or an extension of the ceasefire. I think that the war probably ends at some point, at least temporarily. And I think you'll see the 10-year come down even more. But I don't think it'll come down as much as people expect or think it will just because of this. And here's why. There is a lag effect to inflation. Remember that oil was elevated for many weeks, up to 6 to 7 weeks. And that's going to feed into that CPI data, PPI data that we always get. Understand that data is delayed. So consumer price index, I'm referring to CPI, consumer price index, producer price index, PPI. So that means, and those are the readings that the Federal Reserve is going to look at. So they're going to see when they get those readings being a little bit higher than they were, which is eventually going to happen, it's going to mean that inflation is still coming through the system. It's still, it's got to make its way through. It's a bit delayed with their data, right? Federal Reserve data that they're going to get is going to be a bit delayed. So even if oil drops now, the damage is somewhat, let's call it, partially done. And I think because of that, the Federal Reserve is going to go off of that data, which it always does, and it probably is going to mean, we don't need to lower rates anytime soon. I mean, we've got a pretty strong economy. Jobs are still solid. The last job report was actually pretty good. And inflation, they're going to read it like this. They're going to say strong economy, jobs solid, but inflation is still a risk. And the Federal Reserve works off of a dual mandate, right? They got to maintain jobs. They got to make sure that's one. And then the other is they got to make sure inflation doesn't stay persistent. So if you got a good economy and you got solid jobs, but you got inflation, they're going to focus on the mandate of not letting inflation get out of control. To me, that does not mean they're going to raise rates, I don't think. But it definitely means they're not going to cut rates, right, in 2026. I don't see, in fact, I almost envision a situation where they may not cut rates at all in 2026. I look at the bond market, I look at the 10-year, some of this data I read here in the courtesy of Reuters is, they're projecting the 10-year to stay around this 4 to 4.2% range. That's not a range that you cut rates in, right? The bond market is sort of telling you, it's a tell. And that supports mortgage rates staying high, staying elevated, not collapsing, not coming down as much as we'd like to see to kind of inject some fuel into this, pretty struggling housing market that we find to be pretty unaffordable in most cases. In fact, if you listen to those episodes I've done in the past, it's unaffordable majority of this country, right? So, if I have to forecast this out, at least for now, of course, these things change so quickly, but I don't think rates crash. I think they probably stabilize. They probably get into the low sixes over time. They're not going to see 5% anytime soon. But at the same time, they're probably not going to get back to 7% anytime soon. I do think the biggest risk, though, to this current outlook, let's call it, I have, is another external shock to the system. We can't predict 1 month to the next lately in this environment that we're in. So if war escalates again, for example, if oil spikes again, or if anything else happens that just causes inflation to reaccelerate, rates are going to go higher. It just is what it is. This is all presuming that things kind of ease from here. I hope they do. I think we all hope they do. For many, many reasons we hope they do, but it's all going to be dependent on that. So yes, we may have just seen the peak in rates for now, but this isn't a straight line down. I think we're still in a somewhat volatile environment, albeit a little bit better. And where rates go next depends pretty much on what happens globally, obviously, as we've seen. That is it for me today. Thank you so much for listening to today's show. And as always, if you have questions or need specific advice, ideas, or just some help regarding your particular real estate needs or situation, or if you're just looking to buy or sell real estate in Florida, well then DM me on Instagram at The Salib Group, or just send me an email to mark@thesalibgroup.com. Don't forget to leave a rating for the show, follow, subscribe, help others find the show, and be informed and educated about the real estate market just like you. Until next time.